Good evening, everyone. A warm welcome to one and all to this webinar, ETFy Masterclass with Samir Desai. Samir ji is the National Sales Lead at Nippon India AMC for ETFs. He is a legend in the market, over 30 years of experience across capital market functions such as institutional equity sales, private wealth management, institutional independent financial advisory group, ETFs, indexing, so on and so forth. Samirji will take us through what are ETFs, the basics of ETFs, and he'll explain to us how ETFs and are a good form of passive investing and how it is different from active investing. In the second half of this session, I will take you all through ETFy, IIFL's dedicated platform for ETF investing. ETFy is basically a simplified way through which you can purchase good quality baskets which our research team has created. In the third part of the session, I will go through the Q&A section and Samirji will answer all your queries. We'll try and take as many questions as possible as time permits. With that, let us begin. A warm welcome again, Samirji, and over to you.
Thank you, Headley, and good evening to everyone who's participating in this webinar today. So as Headley said, we will talk about exchange-traded funds or ETFs. ETFs have become extremely popular in recent times. And, almost daily there is some news item on ETFs, either in the financial media, the print media, on television channels. So this shows the popularity of exchange-traded funds. And today, Indian investors have a lot of ETF options to pick and choose from. A lot of ETF schemes are listed on the National Stock Exchange and the Bombay Stock Exchange. As some of you may be aware, recently the Indian regulator has also come out with rules for the launch of silver ETFs. So silver ETFs will be another major category of exchange-traded funds that will be available to Indian investors in the near future. So the presentation is divided into three sections. First, we will look at some of the ETF growth statistics globally as well as in India. Then we shall look at the core philosophy, the indexing philosophy that drives ETFs, because the underlying portfolio of an ETF is essentially an index. And in the third part, we'll see some of the factors which should be taken into consideration to pick and choose the right ETF schemes. So that's how we'll go through this session over the next 40 to 45 minutes. So let me start with the first slide. The first slide of the presentation is a typical trading day on the New York Stock Exchange. So this is typically what happens on the NYSE. All the trading volumes you can see here, the highest trading volumes. And contrary to what we may believe, the most traded securities are not some of the popular companies like Tesla or Apple or Amazon, Facebook, Google, etc. But as you can see in this slide, the number one security is the S&P 500 ETF, which on 15th August 2021, we have taken one snapshot. But as I said, this is what typically happens on a normal trading day on the NYSE. So on this particular day, the S&P 500 ETF had a turnover or a volume of nearly $18 billion, way above the volumes of some of the popular, securities such as Tesla, Apple, etc. And all the shaded rows that you see in this slide are all ETFs. So this tells us that the volumes of ETFs are going up on the US exchanges. People are doing away with the traditional practice of stock picking or stock selection. They are not trying to find good companies, but instead they are buying the markets or participating in the markets via ETFs or indexes. So this is the trend on the US exchanges. So today the global assets of ETFs are almost in excess of $9.5 trillion. No other financial instrument has grown this fast as have ETFs. So ever since the first ETF was launched in 1993, which is the S&P 500 ETF that we saw in the earlier slide, ETFs have seen a very, very rapid growth. And today you have ETFs on almost every asset class. So equities, broad market indexes, sector indexes, thematic indexes, fixed income indices, commodities, and so on and so forth. So asset allocation using ETFs has become very, very easy. So this is the chart or the graphical depiction of the global growth of ETFs. As I said earlier, no other product has grown this fast in financial services history as have ETFs. Let's come to the Indian scenario. So this is the growth of AUMs or assets in the Indian markets. Today, the assets under ETFs are about 3,90,000 crores. And if you consider this as a percentage of the total mutual fund assets, it is a growing number. So the ETF share in the mutual fund industry is ever increasing. And just recently or sometime back, the ETF AUM or assets overtook the liquid fund AUM in India. So there was a news item in the financial newspapers which mentioned this growth of ETFs. So a lot of growth has happened over the last 3-4 years, as can be seen from this chart. And as you can see on the right-hand side, today you have almost 120 different ETF schemes across equities, fixed income, and commodities listed on the National Stock Exchange and the Bombay Stock Exchange. So this is the growth of ETFs in India. What have been the catalysts for the growth of ETFs in India? So way back in 2013, the finance minister in the budget abolished the STT on purchase of equity ETFs. So today, if you buy equity ETFs on the stock exchange, there is zero STT. And if you sell ETFs on the equity ETFs on the stock exchanges, there is a negligible 0.01% STT. Both these numbers are much lower than the STT that you pay for buying and selling stocks on the stock exchange. So this is one of the earliest government incentives to encourage the growth of ETFs. In 2014, the government decided to disinvest via the ETF route. And as a result of that decision, the Central Public Sector Enterprises ETF or CPSE ETF NFO was launched in 2014. So the government evaluated various options and they decided to adopt the ETF route, considering its advantages, which we shall see in the later part of this presentation. Also in 2015, the Ministry of Finance came out with a notification which said that Provident Fund incremental inflows every year, they were mandated to put a minimum 5% in equities and a maximum of 15%. As a result of that mandate, the Employees Provident Fund Organization of India, or the EPFO, which is a large pool of money, decided to adopt the ETF route for participation in equity investments. In fact, the EPFO experience of ETFs has been so good that they have gone up to the entire 15% allowed by regulation. Also in the last 3 years, that is in 2018, SEBI came out with certain regulations whereby mutual fund schemes had to start benchmarking. So that is schemes managed by fund managers. They had to start benchmarking their schemes to the total price index, which contains the dividend component. Prior to this, the mutual fund schemes were benchmarked only to the price index, which does not contain the dividend component. So as a result, the measurements were not appropriate. So this was corrected by the regulator in 2018. Also in 2018, the regulator announced what is known as scheme categorization. So for example, today, if you have a large cap mutual fund scheme managed by a fund manager, then the fund manager has to necessarily select at least 80% of the portfolio from the Nifty 100, which constitutes the large cap definition as per the Indian regulator. So prior to this, what was happening was, if you had a large cap scheme managed by a fund manager, the fund manager would select about 50 to 60% or 70% of the portfolio from large cap companies, balance from mid caps and small caps, benchmark to a large cap index like Nifty and Sensex, and show alpha. So this was again erroneous way of showing outperformance. So this was also corrected by the regulator in 2018. So once the benchmarking measurements became appropriate, what we find is that the alpha has diminished in the Indian market. So it is very difficult to generate alpha. So thereby, one has to look at other options over and above the traditional options that we have been used to, which is either we pick stocks or give our money to fund manager, hoping that they will pick good companies and try to generate a return higher than the index. So this is not happening anymore. As I said, the alpha has diminished, and that is why the popularity of ETFs has gone up substantially over the last few years. So let's now go to the second part of the presentation, which is the index, as an investment strategy. So as I said earlier, the underlying portfolio of any ETF is essentially an index. So supposing you have a Nifty ETF, the underlying portfolio is the Nifty index. Supposing you have a bank ETF, the underlying portfolio is the bank index. So why is index such a potent investment strategy as opposed to stock picking or any other methodology which tries to generate alpha by beating the index? So the first challenge to generating alpha, which is the traditional method of investment, is the immense competition in the business of generating alpha. So this is a data of the number of registered entities in India who are in the business of generating alpha. So who are in the business of generating alpha? As we know, all your mutual fund companies, fund managers try to generate alpha. They try to give you a return higher than the index. Your insurance schemes, they are having a similar mandate. They try to generate a return higher than the benchmarks. Then all your foreign portfolio investors, they have a similar mandate. Your AIFs, PMSs, so many analysts who are in the market, all trying to beat the market. See, this is essentially the endeavor of the traditional method of investment. What is it? Try to generate alpha, beat the index. Now, when you have such an immense competition in trying to generate alpha, obviously everybody cannot generate alpha at the same time. This is the number of registered entities, almost 36,000 entities in the business of generating alpha. Now, if I consider an average of 5 professionals per entity as an example, okay, so you have 35,000 into 5. That means you have a big professional population comprising of chartered accountants, MBAs, CFAs, economists, all competing with each other trying to generate alpha. Now, when there is so much of competition, it is but obvious everybody cannot generate alpha at the same time. Why is that so? Because investors as a group cannot outperform the market. In the aggregate, investors cannot outperform themselves. In the aggregate, investors are the market. So if some professionals outperform the market in a particular time period, then by default, the others have to underperform to that extent. So let's say some professionals outperform or generate a return higher than the market average index in a particular time period. Then the other professionals who are engaged in the same activity will underperform the market, okay, to the same extent. So outperformance is what we call technically a zero-sum game. Everybody cannot generate alpha in the same time period. And let me give you a very simple example to explain this. So I will use the analogy or the example of Mumbai local trains. In Mumbai local trains, what happens is you see the alpha generation almost on a daily basis during the crowded rush hour. How is that? So during rush hour, okay, on Churchgate or CST, a lot of commuters rush to catch window seats. Window seats are limited in number. So everybody will not get a window seat. Now, people who caught window seats on a particular day, let us say they generated alpha. As a result of that, other commuters will underperform or hang outside or stand in the passage. So they are the underperformers. And somebody like me who is an index or the ETF, I did not catch the window seat. I caught the other seat, but I will reach my destination in what we call a risk adjusted fashion. The people who rushed to catch window seats, what did they do? They took excess risk. Okay. So it was not skill. The alpha generation or window seat catching in the local train journey is excess risk. It is not skill. It is exactly similar in the markets too. When you deviate from the index and try to generate alpha, you are taking excess risk. That is what is happening. Okay. Now, in our train journey, let's say the people who generated alpha or caught window seats on a particular day, if you see the subsequent day, maybe they will be the underperformers, and the underperformers of the previous day have caught window seats. So outperformers and underperformers in the train journey will keep changing all the time. And this is exactly what happens in the market also. Professional managers who have generated alpha in a particular time period may not be consistent. So they may not be able to generate alpha consistently in the subsequent time periods because of competition. Okay, so this is the problem in the business of generating alpha. And all of us have experienced this. All of us find that our schemes or our managers to whom we give money, they are outperforming the market sometimes they are not. And this is exactly what Indian data is showing us. So this is what we call the SPIVA scorecard. SPIVA stands for Standard and Poor Index versus Active. So this is the measurement of fund managers against indices. So this is the SPIVA data this is the latest SPIVA data for India. So this is the data as of June 30th, 2021, where we see that in the Indian large cap mutual fund segment, for example, for a 5-year time period ended June 30th, 2021, 82 or 83% of large cap mutual fund managers have underperformed the large cap index. This is the percentage of funds outperformed by the index. So these many fund managers or this proportion of fund managers have underperformed the index. So this is a very, very large number. If you see a 3-year time period, also the number is substantial. If you see a 1-year time period, also the number is substantial. And if you see a 10-year time period, more than 50% of fund managers are underperforming the indexes. And we are seeing that this is happening in the ELSS space also, where there is a lock-in. Okay, normally we hear fund managers that give us a longer time period and we will do better. But ELSS schemes which have a lock-in over a longer time period, the fund managers are actually underperforming, majority of them. Okay, and this is also happening now slowly in the mid-cap space. If we see a old Indian data, 10-year-old data, this is 2009. Okay, here also, if you see 70% of large cap Indian mutual fund managers were underperforming the Nifty. Now, what are the parameters that SPIVA takes into account? First of all, they take into account what is known as correct appropriate benchmarks. Now, this has happened after the SEBI rationalization, which I mentioned in the earlier slide. So SPIVA, what it does is it compares the right benchmarks. So it uses the right benchmarks for comparison. So that's number one. Secondly, SPIVA takes into account what is known as survivorship bias. What is survivorship bias? Supposing you have 50 large cap schemes managed by fund managers. This is the sample available to you from, let's say, you want to select a scheme and start an SIP. Now it may so happen that after 5 years, all the 50 schemes may not survive. the bad schemes or the underperforming schemes may either be shut down or merged into better performing schemes. So surviving schemes, data will get biased in favor of survivors. So you will see that the surviving schemes are showing a performance better than what it actually is, simply because the bad performers went out of the sample. So this is known as survivorship bias. So survivorship bias correction is done by the SPIVA data. So when you take these scientific measurements into account, you see that actually when the measurement is done correctly, most of the fund managers in India are underperforming the indices. Let us look at some of the other data. So this is a straight away a compounded annualized data, again at 1, 3, and 5-year data for time period ended October 31st, 2021. This is the average large cap mutual fund category. That is the category managed by fund managers. Okay. So here, if we see the average large cap category, it has done only marginally better than the index. That means a lot of fund managers would have underperformed the large cap index. This is the category average. If we see 3 years, again, that outperformance of fund management category is very, very negligible. Okay. And if you see 5 years, the fund management category or fund managers in the aggregate are underperforming the index. Now, this is, again, let me remind you, the category average. That means some of the individual fund managers would have done even worse. Okay, this is what it means. This is a heat map. This is the data from March 2008 to March 2021. What we have done here is each of the large cap fund management schemes or schemes managed by fund managers has been assigned a particular color. The names of the schemes managed by fund managers has been removed for compliance reasons. So we have instead assigned a color to each of the fund managers. Now, these are some of the popular mutual fund schemes in India. So we have, in each time period, compared these schemes or ranked these schemes or ranked the fund managers. So, for example, if you see the extreme left-hand column, okay, the first rectangle is black colored. So for a time period ended March 2011, this particular fund manager, who has been given a black color, was top ranked. Now, if you see, as an investor, supposing you saw this ranking in hindsight and decided to give money to this fund manager, you will see that this ranking is falling in the subsequent time periods because of competition amongst fund managers. Okay, so because of competition amongst many brilliant fund managers, this particular fund manager who was top ranked is falling in rankings in the subsequent time periods. So if I put my money in hindsight, because data is always available in hindsight. So if I had put money in this fund manager in March 2011, because he was top ranked, my experience would have been bad because this fund manager has fallen in ranking in the subsequent time period. This is the competition. Okay, so because of competition, the outperformers and the underperformers are changing all the time. So let me use an example from sports. If outperforming fund managers, let's say they are gold medalists in a particular time period, and underperforming fund managers are bronze medalists in a particular time period, then index ETF or index is silver medal position by default, because index is average. So bronze and gold medal positions will keep changing all the time. Outperforming and underperforming fund managers will keep changing all the time. But if you invest in an ETF, you are assured of a silver medal by default. And as we saw in the data in the earlier slide, most of the fund managers are actually in the bronze medal position. Okay, so the index is actually higher than most of the fund managers, and very few fund managers are in the gold medal position. So this is another data set where what we have done is we have taken the big falls in the market over the last 10 or 12 years. So for example, this is the fall during the financial crisis in the United States in 2008, when the indexes themselves fell more than 50%. So what we have done is, if investments were done in the schemes managed by fund managers or the indexes from a market low, then what would be the return over the next 1, 3, and 5 years when the markets recover? Okay. So if we take the financial crisis, then 1 year from 20th November 2008, when the index fell more than 50%, the schemes managed by fund managers gave a return of, on an average, of 94.96% over the next 1 year, 25.27% CAGR over the next 3 years, and 19.5% CAGR over the next 5 years. Now, in the same time period, the two large cap indices did much better. Why have we taken Nifty 50 and Nifty Next 50? Because ETFs are available for both these indices. So supposing investors had invested in ETFs, okay, then the ETFs would have easily outperformed the fund managers, okay? And ETFs are low cost. I will come to that in the subsequent time period. So low cost schemes have outperformed high cost schemes. Let's come to the current Corona pandemic time period. Again, on 23rd March 2020, when the pandemic broke out, the markets fell substantially. Now, from that time period till 15 September 2021, as we can see here, the fund managers in the aggregate, the large cap category gave a return of almost 70% in this time period, whereas the two indices again did much, much better. And we have taken the large cap indices for comparison because these are large cap mutual fund schemes managed by fund managers. So this is an apples to apples comparison. So again, the ETF investors have done much, much better than the category average of schemes managed by fund managers. And again, let me remind you, this is the average of the large cap category. That means some of the fund managers, they would have done even worse. Okay, so their returns would be substantially lower. So from all the data that we have seen so far, it is clearly evident that buying the index via an ETF is a much better option than giving money to fund managers. Okay, so from whatever data that we have seen, it is competition amongst fund managers which is causing the problem, which is what is making individual alphas increasingly inconsistent. So all the data that we saw, what we are trying to say is, we are not saying that there will be no alpha in India in the future. There is going to be alpha, but that individual alpha is going to be inconsistent and it is going to be short-lived because you don't know which fund manager is going to outperform in the future and which fund manager is going to underperform. At least in the index, you know that you will be in the silver medal position. Now, that is exactly what we need to do. So how do we participate in the index? So very simple, you buy an ETF because the underlying portfolio of an ETF is an index. So an ETF has two advantages. It is basically an index fund which you can buy and sell like stocks on the stock exchange. So two major advantages. One is diversification benefits of an index because the index is a diversified portfolio and you can buy and sell it real time on the stock market. Okay, so these two advantages combine to make the ETF a very, very powerful product. So it is basically an index fund. The expense ratio or the cost is much, much lower compared to any scheme managed by fund managers. So for example, a Nifty 50 ETF, you can buy in India for an annual expense ratio as low as 0.05%. As against that, typically a large cap mutual fund scheme will have a much, much higher expense ratio. So what this means is, going forward, if both the index or the Nifty 50 ETF and the large cap fund managed by a fund manager give you the same return, then simply because of cost advantage, the ETF will give you a much higher return. So you have trading flexibility because ETFs can be bought and sold like stocks. Buying and selling is identical to buying and selling stocks. So you buy it through your broking account, and the delivery of ETF shares comes into your demat account. You can put limit orders. You can buy it in a minimum trading lot of just one ETF share. So operationally identical to buying and selling equity shares. Instead of buying individual stocks, what happens is you are buying a diversified index. So that is the advantage of buying and selling ETFs in the cash market. So this is, a snapshot of Nippon India ETF. So what we do is we offer this facility to our investors. We, this is the real-time net asset values of each of our ETF shares, which you can see changing during market trading hours. So for example, on 31st August 2020, the real-time NAV at 1250 in the market was 123 of Nifty 50 ETF of Nippon India. And at the same time, this is the market price of the Nifty 50 ETF. So you can see that this is very close to each other. So if you want to know whether the market price of each of the Nippon ETFs, whether they are right or wrong, or whether, how do you compare themselves? How do you compare these prices? Then what you do is you compare them to the real-time indicative NAVs, which I said they are refreshed every 5 to 10 seconds during the market trading hours. So you can correlate the market price and the real-time NAV of each of our ETFs. So ETFs are very, very versatile. They can be used by traders because you can buy and sell them like stocks. So you can buy them for intraday, you can buy them for short term. Even long-term investors can use ETFs because you can buy an ETF and take the delivery for the longest time period. So you can buy and hold an ETF. Market access. What is market access? So supposing the market has fallen big time, like it did today, as an example. Okay, then and you don't know which stocks to buy or which fund managers to give, allocate money to. Then what you can do is, what you can do is you can simply deploy your money in the ETF and start participating in the market. So if you, on such a day as today, supposing the market fell, what you can do is you can simply put your money in a Nifty 50 ETF or a Nifty Next 50 ETFs and start participating in the market instead of doing guesswork of which stocks to buy or which fund managers to look at. Okay, so this is market access. So ETFs can be used by traders, portfolio managers, fund selectors, and they are used by a variety of investors, right from institutions, so right from the government of India to insurance companies, to treasuries, to high net worth investors and retail investors. All are participating in ETFs. So as I said, asset allocation becomes very, very easy using ETFs because the underlying portfolio of an ETF is an index. An index is a portfolio which is so designed so as to represent an asset class. For example, Nifty 50 index is representative of the large cap segment of the market. Okay, only Nifty 50 can represent the large cap segment. Individual large cap company cannot represent the large cap segment of the market because that company will have its own unique characteristics. So index is designed to capture the characteristics, behavior, and properties of an asset class. So you can combine various ETFs like equity ETFs, sector ETFs, fixed income ETFs, commodity ETFs, and construct portfolios very, very easily. Cash equitization. So this is again, let me take the example of the market fall today. So supposing you have cash and the market has fallen big time and you don't know which stocks to buy or which fund managers to look at, you can straight away start participating in the market by buying a Nifty 50 ETF or Nifty Next 50 ETF or Midcap 150 ETF. Straight away start participating in the market via index ETFs. So this is what we call cash equitization. Core and satellite means combining alpha and beta for asset allocation. So we believe that index ETFs or beta, because index is the beta, that should be the core part of the portfolio in order to ensure silver medal position. So when you invest your money in an index, going forward, you are assured of the index rate of return, whatever it is. So let me give you two examples. Okay, the oldest Nifty 50 ETF in India was launched in December 2001. So next month, it will be the 20th anniversary of the oldest Nifty 50 ETF scheme in India. Now, over the last 20 years, this particular ETF or the Nifty 50 ETF has given a return of almost 15 to 16% compounded annualized. So that is the kind of return an ETF investor would have captured over the last 20 years. Let me take one more example. The oldest Nifty Next 50 ETF. Nifty Next 50 is the index after Nifty. So Nifty is the top 50 companies. Nifty Next 50 comprises of 51st to 100th company. So this is the smaller large cap. Now this ETF, the oldest ETF on this index was launched in February 2003, and its return till date over the last 18 years is almost 19% compounded annualized. Now imagine over this 20 years or 18 years, think of the amount of stocks that have come and gone. Think of the amount of blue chip companies that have come and gone. And think of the difficulties of identifying future blue chips. See, the problem is, how do I identify future blue chips? The problem is, how do I identify future outperforming managers or future underperforming managers today? In index, at least going forward, I am assured of the index rate of return, whatever it is. So we always believe that the core part of the portfolio should be allocated to ETFs, and the satellite component of the portfolio can go into stock picking or alpha funds or whatever alpha strategies that you may be comfortable with. Okay, actively managing long-term portfolio with ETFs means you can take tactical positions using sector-specific ETFs. Supposing you want to take a tactical position in, let's say, the pharma sector, because you're bullish on the pharma sector, then you can put some amount of money in the pharma ETF, where the underlying portfolio is the pharma index, instead of guessing which pharma companies to buy, okay, or which alpha pharma funds to allocate money to. You can straight away buy a pharma ETF. So you have a lot of sector ETFs which can be used for tactical strategies. So these are some of the strategies that one can use, with ETFs, because they are very, very versatile. Now let's come to the last part of the presentation. How do you select an ETF? Now the question that may arise is, every asset management company or every mutual fund company offers a Nifty 50 ETF. So which Nifty 50 ETF should I purchase? So very clearly, there are three parameters that are very, very important. One is the annualized expense. Okay, so this is the cost. Second is the tracking error, which tells me how closely the ETF tracks the Nifty 50 index. And the third is the daily average volume. So clearly here, the lowest cost ETF or the lowest expense ratio is important. So 0.05%, for example, is the lowest expense ratio in this particular case. Again, we have removed the names of the various Nifty 50 ETFs for compliance reasons. So this is the lowest number that one needs to look at. Here also, the lowest number is important, because this tells you how closely the actual ETF tracks the underlying index. And here you have to look at the highest number, because the ETF having the highest trading volume is what is going to give you the lowest impact cost. And what is this impact? Liquidity impact. If the ETF is not liquid, then this number is going to be very, very high. So you will we have a very high impact for buying and selling the ETF on the stock exchange. So the thumb rule is that expense should be lowest, tracking error should be low, and this should be the highest number. So highest volume. So this is a very, very important parameter for selecting the ETF. If the ETF is not having enough volumes, then you should avoid that particular ETF. So for example, if you see Fund 1 and 2, both are Nifty 50 ETFs offered by different mutual fund companies. You see the volume here on an average over the last 1 year is 27.5 crores. And here the volume is only 4.5 crores. And some of the ETFs, Nifty 50 ETFs, you see the volume is even less than 1 crore. Okay. For example, here the volume, this particular Nifty 50 ETF offered by a mutual fund company, the volume is only 2.5 lakhs. Okay. So this is a very, very critical number. So let me give you another example using the same parameters, Nifty Next 50 ETF. Okay. Again, the same parameters, expense, lowest tracking error, and highest volume. Okay. So this is another example giving the same parameters. Another example. So again, various bank ETFs available in the industry. Again, the same parameters. Lowest expense is important. Tracking error should be low, and volume. Again, here if you see this particular ETF, bank ETF, has a daily average volume of 30 crores. This particular ETF, the second highest, has a volume which is almost 1/5 this volume. Okay, so you see the low impact cost over here. So this is very, very important, the liquidity. Again, another example of gold ETFs using the same parameters. This particular gold ETF is having the highest volume. So this is how you select, the right ETF scheme to invest in. Now, this is something about Nippon. Nippon has the oldest track record in the ETF business or the index business in India, what we call passive investing. So there is almost a 2-decade track record because of the acquisition of the Benchmark and Goldman Sachs ETF business. So Benchmark was the asset management company that launched ETFs in India in 2001, and the Benchmark Goldman Sachs ETF business was acquired by Nippon in 2015. So Nippon has the oldest track record. It has the highest growth in ETFs. It was the first to launch a gold ETF in India. It was the first to launch a money market ETF. The first to advise the government of India to disinvest via the ETF route. And this is very, very important. So Nippon ETFs have the highest volumes on the Indian stock exchanges. The share of Nippon ETFs in terms of volume is 73%. So this is a very, very high number, and the highest share in terms of ETF folios in India, almost 60% folio share. So the largest investor base and the highest volumes is what makes Nippon a leader in ETFs in India. So let me summarize. ETFs are a very, very important part for portfolio construction, or a very potent product for portfolio construction, because they are low cost, number one. Secondly, the underlying portfolio is an index, so you do away with the risk of underperformance. And thirdly, portfolio construction or asset allocation becomes very, very easy, combining various equity ETFs, sector ETFs, fixed income ETFs, as well as commodity ETFs. So with this, I end my session, and now we can go to the next session. Thank you so much.
Thank you, Samirji. Thank you so much for this detailed explanation about ETFs. And it was very well explained in terms of the basics and how they are different and how well they are performing compared to actively managed mutual funds. With this, we will go to the second half of this session. I will take you all through IIFL's ETFy platform. Before I do that, I'll just share my screen. Samir sir, can you? Yes. So this is IIFL's ETFy platform. We have created this platform dedicatedly for ETFs. Uh, this is created based on customers' feedback saying we do not know which ETFs to purchase and how to purchase ETFs. Uh, ETFs, unlike stocks, their script codes or the names of ETFs are not so popular. Hence, customers have a difficulty in terms of identifying which ETFs to buy. Our research team has put together some excellent theme baskets for ETFs, and hence by a few clicks, an investor can purchase the best performing ETFs. Before we go into the baskets, I will just take a minute to explain why these baskets or why ETFs uh, could be extremely beneficial to the investor. Number one is basically it is much cheaper than even direct mutual funds. So like we saw in Samir's slides, the expense ratio of large cap ETFs is barely 6 to 7 or 8 basis points compared to 1.5 to 2% for actively managed mutual funds. Hence, ETFs are extremely cheap in terms of expense ratios. Whatever you save on expense ratio translates to higher returns for the investor. In case ETFs are also tax efficient. Now, why do we say that? One is because uh, anytime you try to rebalance your portfolio, there's a capital gain involved, and which is taxable. However, given that ETFs rebalance the portfolios based on the index constituents, it is at the AMC level and not at the individual level. So if you buy an ETF and hold it, whatever rebalancing is done at the underlying ETF, the impact of that is doesn't fall back on the investor. So that is done at the AMC level. Hence, it's extremely tax efficient. You can start off purchasing these ETF baskets for as low as 500 rupees. Some excellent theme baskets, which I will show you in due course, as low as 500 rupees. These baskets are diversified, so you can get diversified asset allocation. So you can get debt, equity, gold, all types of, you can have very constructive portfolio is what you can create by purchasing any one of these baskets. There is no lock-in. You can, this is as good as buying a stock. You can buy any of these baskets. Those particular ETFs get transferred to your demat account, and you can sell them as and when you would like to. There is no lock-in absolutely, and can be traded during the day. So Samiji already explained to us how uh, ETFs can be sold even during market hours, and you don't have to wait till the end of the day to get an NAV, like in case of a mutual fund. With that, we will go into the baskets. Now, we have created 7 baskets as per various themes for our investors. Uh, First and foremost, we have a hybrid basket, which gives you a good combination of equity and debt in the form of Access Hybrid Wealth Enhancer. We have Nippon India Transformation. I will take you all through this basket in detail in some time. The Nippon India Transformation is basically a basket which is focusing on the infrastructure theme, which we are extremely positive upon. If we take into consideration next 4 to 5 years, the amount of capital expenditure which is going to happen in the economy, we believe this basket is very well poised to take benefit of that. We have India Consumer. With this basket, you get access to the best quality consumption facing companies, not only in India, but also in the US. So we've created a extremely good basket over here for you all to take advantage of the growth in consumer focused companies. Sustainable India, we all, as we know, ESG is increasingly gaining prominence and a lot of importance, and a lot of corporates are increasingly focusing their attention towards much better ESG practices. And hence this Sustainable India basket is focused on the ESG theme. We have Smart Portfolio. This is a very niche kind of strategy. It's a smart beta strategy, and you can get benefit of uh, smart beta strategies, as well as there's a component of gold as well. So it's a mix of asset classes. Emerging opportunity. This is for an investor who has long-term goals, who's an aggressive investor. Uh, it's a mid-cap oriented basket, and it's built for the long term. India's top 250. Within this, it's a large cap oriented basket, and you get access to the best top 250 companies in India. Now, if you click on any of those baskets, this is what you can see here. You can see the minimum amount of investment. You can see the performance of these baskets, and you get the entire methodology and the basic understanding why we have created the theme of this basket is given over here in detail. The Nippon India transformation. This is a relatively new basket which we have created, which is focused on the infrastructure theme. We believe there's going to be a lot of spending both from the government side as well as the private sector in terms of increasing their capacity, in terms of operational efficiency. So a lot more factories, a lot of roads, railways, bridges, the power sector. A lot of reform is going to happen in over there. So we believe this is a strong theme which is going to develop over the next 3 to 5 years, and hence it's a very good time to invest into the Nippon India transformation basket. It is if you go into the composition of this, it's a very well diversified basket. Also, if you look at it, we have 30% into the Nippon Indian bank piece, which is capital. Basically, in order to no infrastructure can be funded without capital, and hence we believe banks would be amongst the major beneficiaries of uptick in credit demand for credit by the private sector. The PSUs, the CPSE ETF, the companies in there are extremely cheap in terms of valuations. The dividend yield which you're getting is significantly higher than what you would get in a Nifty 50 composition. So we believe there's a lot of value in this public sector ETF. And the Nippon India Nifty 50 infra base, which we've allocated 50% of the portfolio. You get access to the best telecom names, the power sector, defense, you name it. It's a very good composition in terms of the underlying stocks. So just by purchasing this basket for a little over 1,000 rupees, you get access to this growing and strong theme of infrastructure development. So Nippon India transformation, you can make a lump sum investment. You can start an SIP as well. Like I said, there is no exit loads. You can redeem your investment anytime, and we believe this is a very strong theme going forward. Similar is the case for the India consumer basket. Just for barely 436 rupees, you get access to the consumption focused companies. The Nippon India Nifty India consumption ETF has been given 50%, the Mirai Fang ETF. Through this, you get access to companies such as Facebook, Amazon, Google, Netflix, and the ICICI Pru Healthcare ETF is given another 20% allocation. So this entire basket is what you get by paying just 436 rupees. You can start an SIP as well into this particular basket. So with that, we come to an end to the second part of the session. We'll now move into the Q&A. So first question is, which ETFs are better, index or the sector-wise ETFs?
See, I think, as Headley have just pointed out, I think it would be fruitful for investors to buy the curated baskets, that are being offered by somebody like IIFL. So, for example, just to reiterate the Nippon India infrastructure theme that you just mentioned. See, when an investor buys that basket, curated basket, with as little as maybe 1,000 rupees, you are getting indirect exposure or exposure to a lot of companies who are engaged in the infrastructure creation, right from, as you said, banks to the CPSEs to the infrastructure companies comprising the infrastructure index. So I think the curated baskets is probably the way to go, and I would encourage investors to look at the ready-made mixes that are being offered by IIFL instead of engaging in the guesswork themselves about which ETFs to combine with what, etc., etc. So I would encourage that route of participation.
Given that ETFs do not have a fund manager risk, of a fund manager basically moving out, should ETFs be the most preferred vehicle for long-term investing?
Yeah, so there are two major risks of investing, and if I may use a slightly technical language, what we call the systemic risks and the non-systemic risks. Okay, so the systemic risk is the market risk. So if the market falls, everything falls, whether it is stocks, schemes managed by fund managers, and ETFs, that is indexes. So everything will see a fall. Only thing is the stocks may fall more or fall less than the index, and likewise for the managed schemes. But when you sign up for an ETF, okay, or an index investment, you are doing away with what we call the additional non-systemic risk, which is the fund manager risk. Because see, fund manager also, is a risk in the sense that he has his own opinion, his own views. So that is also a risk, as well as what we call the stock specific risk. So when you're buying individual stocks, okay, they have their own unique risks over and above the market risk. So the non-systemic risk of the fund manager or stock specific is over and above the market risk. Market risk itself is significant at times, as we have seen. So why sign up for additional risks? So that's the reason why you should minimize your risk by investing in ETFs. So you are exposed only to the systemic risk.
How does expense ratio impact one's returns?
So lower the expense ratio, higher is the return. Again, let me reiterate the example that I used in the presentation. Supposing you have a Nifty 50 ETF having an expense ratio of 0.05% annualized, and let's say you have a large cap alpha fund whose expense ratio is multiple times higher, and both over the next few years give a return of, let's say, 15% CAGR. Okay, then merely on the cost advantage, because the ETF has a lower expense ratio, more money will accrue to the kitty of the investor than the scheme which is managed by the fund manager, which has a higher cost. Okay, so obviously the corpus that will accrue to the investor will be lesser.
So can SIPs be done in ETFs?
Yes, SIPs in ETFs have to be done through a stockbroker like IIFL. In a traditional mutual fund scheme, you do an SIP directly with the asset management company. But in ETFs, most of the brokers, I mean, at least large brokers like IIFL offer what we call the stock SIP facility, where it would be more fruitful to buy ETFs rather than guess which stocks to buy.
Right, right. So what percentage of my portfolio should I put into an ETF and maybe an actively managed fund?
So if you recall, I had shown a slide of core and satellite asset allocation. Now, what percentage should be core? So the core should go in an ETF. So you'll at least get the index rate of return. But what proportion should be core and what proportion should be satellite is, I think, a discussion between the investor and his advisor, because that will depend upon his risk profile, life cycle goals, and so on and so forth. So that's a personal one-to-one discussion. But on a broad level, the core and satellite asset allocation approach should be followed.
Right. We have a question in terms of what is the benefit in terms of taxes? Yeah.
So securities transaction tax is one kind of tax, which I said that, as I said, that when you buy and sell equity ETFs on the stock exchange, on purchase of equity ETFs, there is a zero STT. On sale of equity ETFs, there is a negligible 0.01% STT, much lower than what you pay for buying direct equity. And as far as the long-term and short-term gain is concerned, it is for equity mutual funds, it is identical. For equity ETFs, it is identical to equity mutual funds. And for gold and debt ETF schemes, it is identical to debt mutual fund schemes.
Right. I think in regard to sectoral ETFs, you already have answered that question. So if outperformance in actively managed mutual funds is not consistent, should one prefer ETFs?
Yes, because see, as I again, let me reiterate the example that I'd used of gold medal, silver medal, and bronze medal. So if you are not assured of the gold medal position, at least you can do away with the assurance that you will never end up in the bronze medal position, because in an index, you are always at the silver medal position. So in other words, you are assured of the index rate of return, whatever it is going forward, because outperforming and underperforming fund managers will be known only in hindsight. So at least one is assured of the index rate of return, and which has been good enough in India to meet financial objectives. See, that's the very important part. So don't think that the index rate of return is not significant. It is good enough to meet financial objectives by doing away with the additional non-systemic risks.
Right. The next question is in terms of the brokerage involved. I'll take that. So for ETFs, whenever we purchase an ETF, whatever brokerage is applicable to stocks, that is applicable to an ETF. So based on your individual plan, the same brokerage would be charged for the ETFs as well. Can you speak about gold ETF? I mean, the way it functions, just briefly.
So gold ETF was designed to do away with the hassles of buying physical gold. So one does away with those hassles, because physical gold, for an investor to buy, store, has its own problems. So the gold ETF does away with those problems. So when you buy a gold ETF, you are indirectly taking exposure to gold as an asset class. So gold ETF is generally used in asset allocation because gold has a low correlation to equities. So you combine it with equities in asset allocation to dampen the volatility of equities. Okay? So the overall risk-adjusted return of the portfolio is much better when you combine equities and gold, because both asset classes do not necessarily move in the same direction. So that's the reason for buying or taking exposure to the gold ETF.
Sure. We have this question in terms of is dividend received on an index ETF? Just on the dividend aspect, if you can highlight.
Yes. So dividends, it is up to the asset management company whether to declare a dividend in an ETF or not. But even if the AMC does not declare the dividend, the aggregated dividend is reflected in the scheme NAV, okay, in the ETF NAV. So think of ETF as something like a growth option equivalent of your traditional mutual fund scheme. So if the AMC does not declare the dividend, it is aggregated in the net asset value of that ETF scheme.
Right. This is in regard to the split of stock happen in ETF also. So I believe in terms of corporate action, how does it play out?
So I think split of stock is the question related to whether the ETF does a stock split like it happens in stock.
Yes.
Is that the question?
Yes.
Yeah. So see, in the ETF, what may change is the face value of the scheme. So, for example, some time back, the face value of some of our schemes was brought down from 10 rupees to 1 rupee to encourage retail participation. Okay. So that is what can happen in an ETF.
All right. So with that, we come to an end of the Q&A session. I would like to thank Samirji for patiently taking up all our questions and explaining to us the basics of ETFs and going through the entire presentation so that we explain the nitty-gritties of an ETF. I would like to thank all of you, all the participants who have, and the audience who have joined this section. Thank you so much for joining in and participating in this webinar. We will continue to have this webinar going forward as well. So if any queries, please post it in the Q&A section in our webinars ahead as well. I would like to also thank Ankit for helping us coordinate with this webinar. And we look forward to having Samirji again back with us for the next section. These sessions are extremely fruitful. And thank you so much for coming in, Samirji.
Thank you, Headley, for having me over, and thank you to all your IFL colleagues also. And thank you, participants for hearing me out. Thank you so much.
Thanks.
With that, we come to an end. Thank you so much. Participants can disconnect. Thank you so much.